Today we're talking about inflation. So always a very exciting topic because though we always think of inflation as a bad thing, anytime we see something bad in the economy, there's always some kind of opportunity there that we can take advantage of. So I know a lot of people get hurt by inflation, but there are ways, if we're smart about it and if we're resourceful, that we can actually take advantage of this situation in the market. Today, I wanted to talk about 5 different reasons that I believe that inflation is here to stay. And then after that, we can talk a little bit about some solutions that we've got, some ways that you can take advantage of the situation that we find ourselves in. So we know that inflation is here. It's in the mid 5% right now in Canada. It's up above 7% in the US. And that's for the CPI, the measurement that we use to look at consumer price inflation. So a lot of people may believe that this is going to be short-term in nature. I know the Federal Reserve in the US has said that it's transitory, but there's a number of reasons that I believe at least the core inflation is going to remain. And again, we'll talk about those and talk about some of the ways that you can take advantage of that. So number 1, and this is something that's not new, but in 1971, the US decoupled the US dollar from its gold reserves. So the currency is now fiat currency. You've probably heard that word tossed around a little bit. It's no longer an asset that's backed by gold. So that's number 1. And as we go through and as we at least get to the second half of the presentation, I can go into these in more detail and talk about why exactly that's such a problem when it comes to inflation, or why it is maybe not a problem in some cases, but at least it's inflationary. Number 2, the government keeps printing money, and the government keeps printing money as a result of various crises that come up. But what we're finding is every single time one crisis ends, there's another crisis that appears. So though the money printing really was supposed to be used for very extreme measures in the economy, we're finding that it's being used over and over and over again, and it never seems to end. Number 3, when we look at inflation, a lot of people look at inflation and they think it's kind of one thing. They see the consumer inflation, the one that's usually reported on, and they think, okay, that's what inflation's at. Some people have some theories that it may be a lot more than what's currently reported. But what actually happens, or what has actually happened, especially since 1971, where we came off the gold standard, inflation, there are 2 types of inflation right now. There's asset inflation and there's consumer inflation. Consumer inflation is with the regular things that we use for daily life, food, clothing, maybe electronics, those kind of things that are in their basket. But then there's hard assets also, and the hard assets are things like real estate. To some extent, the stock market is one of these hard assets. What we've seen is consumer price inflation at around 5%, but something like real estate is up at 10% over the same time period. So we're seeing these hard assets double the inflation rate of the consumer assets. Next, we have the US, which is no longer it is right now, but we're coming into a world where it's no longer the reserve currency. So there's a few different things I could say about that, but it is no longer the reserve currency.
It used to be the power currency that everyone's like, oh, based on the US dollar. But
exactly.
Slowly,
and today,
slowly they're losing its power, right?
Exactly. It's a gradual process. And then when we look at the government incentive to keep inflation, So the basically the incentive for the government is they want the money. They don't necessarily want us to have the money, and they have two choices for what they're going to do, especially about the government debt. Number one, they could raise taxes and get everybody upset with them. Number two is they could print a whole bunch more money and nobody even notices. So the government has an incentive, of course, to keep more of the assets for themselves. And they also have an incentive to take that money in such a way that we're not going to notice if possible.
So the 5 reasons, just to summarize, is number 1, money taken off the gold standard. Number
Exactly.
2, government is using crises to print more money. Number 3, there's actually 2 types of inflation. One is asset inflation, as in hard assets, real estate, stock market. And the second one is consumer inflation, as in food, clothing, gas, etc. Number 4, the 4th reason why inflation is here to stay is US currency slowly losing the global currency standard. And number 5, the government is incentivized to keep inflation going because they want more money. And if they have 2 choices regarding government debt, either raise taxes or print more money, they probably will do the latter, right?
You should be doing the presentation, Gary.
I'm just taking notes. I'm taking notes on what you're saying.
So that's exactly what's happening right now, why I believe that inflation is here to stay. So as I said at the beginning, there are ways that we can actually take advantage of the fact that we've got inflation, especially when we have these 2 types of inflation that are going at different rates. So I'm going to talk a little bit about some solutions that we can do, and this is within our corporation, in our corporate balance sheet. So if we look at inflation, there are 2 different aspects to inflation. There's the assets and there's the consumer inflation. So when we're looking at what we have on our balance sheet, generally people have primarily cash. And what we found right now is that cash, the value of cash is going down. So what we want to do within our balance sheet, within our corporation, is we want to change the way we're allocating our cash. So we want it to be what we call in the industry a cash wedge. So essentially what we want to do is we want to cut out a certain area, and that area will be cash, and this will be just enough cash to handle the operations of the business. So how much money do I need for the next 3 months to operate my business? That's the amount of money that we're going to allocate to the cash.
Okay, so we create in the corporation, we create a cash wedge.
Exactly.
Okay, cash wedge.
And then what we want to do is we want to take a portfolio approach to our corporate balance sheet. So the assets that we actually carry in our corporation are not only going to be cash as they were before, we're going to have our cash wedge. Maybe we'll have some real estate. I would suggest that we'll have some insurance, and maybe we have some kind of equity exposure. So now when we look at the different assets and how they're affected by inflation, our cash, of course, over time is going to decrease in value and potentially decrease quickly in value. Our real estate is likely to go up in value because in an inflationary environment, it goes up. The insurance is going to go up in value, and the equities are going to go up in value. So I'm simplifying this. Of course, equities go up and down over time, and they go up and down over time for different reasons. But it's likely in this environment that they're more likely to go up than they are to go down. So another thing that we want to do with our balance sheet is, I'll draw that out again. So we want to have it in such a way. So we've got our cash, we've got our insurance, we've got our real estate, and we've got our equities. We want to make sure that all of these operate as much as possible in a way that's going to reduce tax. Because we know that this cash is always losing value over time, we want to make sure that there are any other area of the business where we're losing a lot of money, we want to make sure that we're losing as little money as possible. So this could be true in any environment. Any time that we're in a situation where we've got a corporation that we're running, we probably want to reduce our tax, but it becomes more and more important when you know that some of your assets are definitely going to be decreasing in value. So the other thing that we've got going for us right now is we've got very low interest rates, which is very common in this part of the market cycle. So even though we're looking at a recent hike in interest rates, it's still -3% that most people can borrow money at. So this is still a very low rate. So what we probably want to do is borrow money. And what we find when we start putting these strategies together, so we want to use our cash and insurance. We want to use these two things as collateral so that we can borrow money to get our real estate and equities. This borrowed money will give us tax deductions. So we've got a low interest rate, we've got tax deductions, and we've got assets that are counter-inflationary. So what we've managed to do in 3 different ways is we've managed to protect our balance sheet from whatever this number is, this 25%, that we know is going to decrease in value over time.
Okay, so Carl, I'm just going to stop you right there. So I've heard this before, but many of us haven't. Many of us on this webinar haven't. So maybe simplify again. So step 1 is to create a cash wedge strategy. Is that correct?
Yeah.
Step 1 is
I'll put it up here. Cash wedge.
Create cash wedge strategy. And then step 2 is to invest in hard assets.
Yep.
And then so hard assets could be like private equity or equities, insurance, and real estate.
Exactly.
Right? And then step 3 is to yeah,
this one kind of goes here. Step 3, to reduce tax.
Yeah, so step 3 would be to reduce taxes. Okay, reduce taxes by using insurance and cash.
Yeah, and cash. Using our insurance and our cash as collateral.
As collateral, okay.
That we can use to borrow money to go into these harder assets, which actually should be increasing at faster than the inflation rate over time.
So step 3 is reduce taxes by using insurance and cash as collateral to be used towards purchasing. It's used to borrow, reduce taxes by using insurance and cash as collateral to be used to borrow cash towards buying equities and real estate.
Exactly.
Okay.
So on this side of the balance sheet, what we've got an asset that will increase over value in value tax-free in the insurance. With the equities, every time we sell out of these, we get the opportunity to pull money out of the corporation tax-free.
Yeah.
And to a certain extent with the real estate, we have a similar opportunity. So what we've managed to do is we've managed to use a few different tax strategies together to reduce the tax, which is really a drag on the increase of the value of the assets. And we've reduced our exposure in this example anyway to only 25% of the inflation that we would have had experienced otherwise.
Okay. So probably, step one, create cash wedge strategy. Step two, invest in hard assets as in equity, insurance, and real estate. Step three is to reduce taxes by using insurance and cash as collateral to be used to borrow money. Step four is use the money towards buying equities and real estate that appreciates faster than inflation.
So if we do these steps, actually, we should thrive in times of inflation rather than be caught off guard in times of inflation. So that's essentially the strategy. We've got over a lot of information.
Yeah.
I don't know whether we want to turn it over to questions now.
Yeah, we covered a very surface. We covered the surface level. So we have a question from Ava Lee asking, is there any example, please, to explain the strategy of how specifically, can you give us a particular case study?
Yeah, I can give you a case study.
Yeah.
So again, this is a manufacturing client, and it's going to be very similar. He did the same kind of thing, but he did it in a slightly different way. So I think you'll see the similarities. So I have a client, he's got a manufacturing business. So within his manufacturing business, of course, he's got a certain income that comes in. His expenses in his business are quite expensive. So what he was doing is he was getting the income and basically paying the expenses, and any extra money he had, he was putting directly into real estate. So he was already doing part of this. He was putting about 50% of the extra cash into cash and 50% of the extra money into real estate. So what we did to change his situation is we started looking at more hard assets within his corporation. So he was putting that money directly into expenses. What we did is that income that was coming in, first we put it into insurance. And then we borrowed against the insurance to cover his expenses. So now he had this step between where this asset was growing in value. He also put a little bit of his cash also that he was using as his float anyway as collateral. So he started running all his expenses through this. And what he was able to do is he was able to still put that 50% into the real estate. And now he had this 25% allocation into the insurance as well. So he was able to bump up the amount of hard assets that he had within his corporation. And because he was borrowing this money out, the interest and the insurance costs were all tax deductible, and the insurance grew tax-free. So it was growing at higher than the inflation rate. The real estate was growing at higher than the inflation rate, and he was able to reduce his taxes at the same time. And he was able to take advantage of the cash that was just sitting there on his balance sheet, not really doing anything for him. So as a result, he saved a lot of money in tax, and his assets within the corporation increased at faster than the rate of inflation.
The question that Ava asked was, what type of insurance? Universal life?
No, we wouldn't use universal life for a strategy like this. We need something that's really going to grow in value over time. Universal life can be very good if we're just looking for cheap insurance. But what we're looking at is an asset that's really going to grow substantially in time, and that kind of insurance. And there are different types of this insurance, but it's a whole life plan. And it's a special kind of whole life plan that I like to call a capital pool. because what we want to focus on primarily is how we are going to grow our capital. We don't want to look at a whole life plan that gives us a very big death benefit and a small cash value. We want a small death benefit and a very big cash value. We want it to look like an investment and something that's going to appreciate substantially over time. So really, we'd be looking at a whole life plan and specifically a capital pool whole life plan. Well, the premium for this plan that we did was $300,000, but we can do strategies like this with as little as $50,000. So really, when we're looking at the premium that we're going to allocate to a strategy like this, 50,000 is the base, and we can basically go up as high as you want from there.
Another question, what's the advantage of a whole life versus an ETF or a stock, since we don't seem to care about the death benefit?
Okay, so one thing I'd like to say is that I wouldn't want to say that the whole life is going to be the only asset that you put your money into. If you're looking at a strategy like this, you probably want your ETF in there anyway. And then you want your real estate, cash, and then you want your insurance. So what we're doing here is we've all heard about diversification. And there's a traditional view of diversification that we want to retain here. We want to diversify our assets into different types of assets. That's one thing we want to do. But we want to diversify it further than that. We want different assets that are doing different things inside the corporation. So if I look at an ETF, I'm going to just pull out two parts of this and how they function differently. So here we've got the ETF and here we've got the whole life. So I'm just going to let somebody in. So the ETF has certain advantages, especially at certain times. Maybe at some times the rate of return is going to be greater than what we've got in the whole life. One of the issues that we have is that if we try to borrow against the ETF, especially if it's one with higher returns, which probably means more equities, depending on the plan, we're looking at 50% that we're going to be able to borrow, and we've got the potential of a margin call if our assets fall. So we've got our higher IRR, which is good. We've got very bad lending conditions with the ETF. And then the other thing is that we don't really have any kind of tax advantage. We have some small tax advantages, but tax isn't really the reason that you put the money into the ETF. With the whole life, we've got an ROR, which is reasonable. We're probably looking at around 4%. So there are certain ETFs that would be able to beat that. But we're looking at 100% loan to value when we borrow against it. And we're looking at no margin. So we never have to worry about a margin call. It's similar to having a mortgage within your corporation. And there are lots of tax advantages. Number one is that it's going to be able to grow tax-free. And number two, we're going to be able to pull that money out of the corporation tax-free eventually. So, and because we can borrow against this so effectively, we're going to be able to deduct a lot of money over time from the leverage that we're doing. So it's not that an ETF is wrong and the insurance is right, but what it does is the insurance allows us to use the leverage to get the ETF so that these two things can work together to give us a much higher return, because now we're combining the fact that we've got the higher ROR, we've got the great leveraging, and we've got a lot of tax advantages. So it's not that one is better than the other. It's that in combination, they're much stronger than they would be individually.
So the question was, how does the whole life generate value? Does it not invest in the stock market? The tax advantages are mimicked in a TFSA, no?
So, so the last question is very easy, so I'll go over that one. It is like a TFSA, but in this case, it's a corporate TFSA. We're using it within the corporation. There is no government plan for a corporation that allows you to save money tax-free. This is only to be used for a person. So in our business where we've got a corporation, this allows us to bring all the advantages of the TFSA within our corporation. The other thing about a TFSA, just quickly, is that we can't borrow 100% against our TFSA. We can borrow, especially if that TFSA was an ETF, we can borrow 100% against the insurance. So another thing with the insurance from a purely tax perspective is that the money will eventually come out of the corporation tax-free, whereas a TFSA, even if you could hold it within a corporation, there's no provision for that money to come out of the corporation tax-free. So those would be my points on the TFSA. And with your other questions, how does it increase in value? Does it invest in the stock market? Yes, it does. So I'll just draw a quick portfolio, and this is fairly arbitrary to show you the assets that we would have in a typical whole life plan. So we would have real estate, we would have bonds, we would have equities, and we'd have private placement. We'd also have, in some cases, some private equity. And that would pretty well be, oh, sorry, we'd have some cash presumably in there, probably a smaller portion of cash. So yes, we do have the equities and we do have the bonds, which are two things that you would typically see in an ETF. But because the insurance companies have a time horizon, typically the time horizon with an ETF is anywhere to 1 to 3 years. People generally do not hold money for a long period of time in an ETF. It doesn't typically happen. Whereas the people in their whole life plans, it's right in the title how long they're going to hold the money within that plan. It's for their whole life. So we're typically looking at anywhere from 30 to 60 years that people are holding the money in these plans. And this is a bit of a long-winded explanation for why we can have things like private placement, real estate, private equity within the plan. Because we have such a long time horizon, we can get more and more into the private assets, and we're not restricted to assets like equities and bonds that have a lot of liquidity. So we can get outsized returns from the fact that we don't need the liquidity. When we look at the risks typically in an investment, it's not that one investment is risky and one investment is safe. It's that you're taking different risks with different investments. So with your ETF, you're taking no liquidity risk. You could put that in right now, and then 1 minute later, you could take all the money back out again. So we're taking no liquidity risk. But what we are taking is a volatility risk. So it'll go up and down a lot over time. Or the rate of return is going to be quite low. When we look at the risks that we're taking with a whole life plan, especially because of the private equity, or actually, let's just look at the private equity because I don't want to muddy it up with the other investments that's in the whole life. We are definitely taking a liquidity risk because that money might be stuck in there for 10 to 20 years in some cases. Maybe they're building a building downtown. It's going to take a certain amount of time to build it. They're going to take some time to actually tenant it so they get their money out of it. And then maybe they're going to sell it again in 20 years. So that money's been tied up for 20 years. Me as a person, I really care about that because I'm probably going to need that money within 20 years. But when we look at an insurance company, they really don't care. It can take as long as, it can take 100 years to get that money out. They don't care. So this risk is not something that they need to worry about. So what we can do is we can get higher returns by taking liquidity risk without having to take all this market risk or counterparty risk that we would have to take in another kind of investment. So I apologize if I went into too much detail there, but you may have other questions. Maybe I didn't go into enough, but that would be the reason I'd want both those assets in there rather than one or the other.
And Carl, typical question, what does this strategy, like who does this strategy apply to?
So this strategy is for a business owner, and that business owner should be corporate. And really for this to make sense, they should be making $300,000 a year in their business or more.
Mm-hmm.
And there should be some kind of tax issue that we want to deal with. So if they're making $300,000, they're spending everything they make, they're not paying really kind of any kind of tax, then probably there's no real tax issue for us to face. But if they either are currently facing a tax issue or expecting some growth where they will expect a tax issue over the next couple of years, then it would be something they probably want to look at.
If you want to contact Carl directly and ask him about your specific situation, just feel free to reach out. If his contact information wasn't in the email, we can provide you his contact information. Eventually, this webinar will be on YouTube as well, and his contact information will be on there as well. Yeah, if you have any other questions, feel free to reach out to me and I can pass you Carl's contact information. And yeah, stay tuned for next month's topic. We haven't defined what that topic is, but we'll let you guys know. Carl, do you have any final lasting words?
No, just thank you very much. And I think there's a few things actually that I do want to say. Number one is that this isn't general financial advice. This is really meant to just talk about some different issues and what's going on, what we can do about it. Really, if you want to look into any of these strategies in more detail for your own specific situation, you could either talk to me or talk to your financial professional so that you get some professional advice as to whether they make sense for you or not.